Hi, welcome to Rec TV. Today we are going to discuss about income exempt from tax. This is one of the topic from direct tax. Let us see analysis of section. Section 10. This deals to income exempt from tax, and section 10AA deductions from gross total income in relation to a business operating in SEZ, and section 11 to 13 exemption in relation to charitable trust, that is the trust should be registered, and section 13A exemption in the hands of political party, it should be also registered, and section 13B exemptions in the hands of electoral trust. Let us see in brief. Section 10 subsection 1 deals with agricultural income. Let us see about agricultural income. Agricultural income is exempt from tax under section 10 subsection 1. The meaning of the term agricultural income is given in section 2 subsection 1 in clause A. Therefore, unless and until an income is covered by section 2 subsection 1 clause A, we cannot term it is a agricultural income. Let us take example. Agricultural activity carried out on a land situated outside India cannot be termed as agricultural income. So friends, agricultural income is exempt from tax. Thus, this is derived from section 10 and subsection 1. Next, section 10 subsection 2 that deals with share of profit received by a member from in HUF. Section 10 subsection 1. This section deals with agricultural income. Therefore, agricultural income is exempt from tax under section 10 subsection 1. The meaning of the term agricultural income is given in section 2 subsection 1 in clause A. Therefore, unless and until an income is covered by section 2 subsection 1 clause A, we cannot term it is a agricultural income. Suppose agricultural activity carried out on a land situated outside India, we cannot term it as a agricultural income. Next, section 10 subsection 2. It deals with share of profit received by member from its HUF. If a member of HUF receives his share of profit from its HUF, such receipt of profit are exempt in the hands of members, because the tax already paid by the HUF, so it is exempt to their members. Section 10 subsection 2A. Share of profit received by a partner from its firm. Share of profit received by a partner is exempt from tax under section 10 subsection 2A. What is exempt? Whether it is profit, remuneration or interest on capital. Here the answer is the exempt is only share of profit. If the partner draws any remuneration or interest on capital, such amount would be taxable in the hands of partners under section 28. So therefore, only profit is exempt from tax and all other remuneration and interest is taxable under section 28. Next, section 10 subsection 10BC. Amount received from a disaster. In a case, if an individual or his legal heir receives any compensation from central government, state government or local authority, then such compensation is exempt under section 10 subsection 10BC. For disaster defined under the Disaster Management Act 2005. Section 10 subsection 10CC. In practical life, an option has been given to the employer to pay tax on the non-monetary perquisite offered to the employee. Tax treatment of such tax paid on non-monetary perquisite, it is divided into two, that is in the hands of employee and in the hands of employer. In the hands of employee, such tax paid by the employer is a benefit in the hands of employee. However, such benefit is exempt in the hands of employee under section 10 subsection 10CC. Now when we goes to in the hands of employer, such amount paid by the employer is an expenditure. However, such expenditure not allowed for deduction as per section 40. Section 10 subsection 16. It deals with education scholarship. If any amount received by a scholar for meeting the education expenses is fully exempt. it is not the requirement. Money should receive only from government. That is, scholarship received from ICI or any parliament or any other is also exempt. Next, section 10 subsection 10d. It deals with amount received from life insurance policy. Any amount received from life insurance policy is exempt under section 10 subsection 10d. However, in the following situation, the any amount is not, if any amount received is not exempt. That is, keyman insurance policy, that is fully taxable. Amount received from a policy as referred in section 80dd. And C, amount received from a policy where the premium paid per annum exceeds 20% or 10% or 15% of sum assured. Note for C, amount received by a legal heir, then such amount is exempt under section 10 subsection 10d. Next, section 10 subsection 20. It deals with income of a local authority. If local authority have a house property income or capital gains or IFOS is fully exempt. Now when it comes to the business or profession, it is again divided into two. If the business is of supply of water and electricity, it is fully exempt. And in other activities, if such activity performed within the municipality limit, it is also fully exempt. Beyond within municipal limit, it is taxable. Next, section 10 subsection 18. It deals with pension received from a gallantry award winner. In a case, if an individual or his legal heir receives pensions, such pension is exempt from tax. Individual, here in this case, individual means such individual should be a bravery award winner and he should be a central government employee. Next, section 10 subsection 19. In a case of a legal heir receives pension, such pension is exempt from tax under section 10 subsection 19. Individual lost his life during the office and he should be a central government employee in this case. Next section, section 10 subsection 32. Exemption post clubbing of minor income. We know as per section 64 subsection 1a, income earned by a minor will be clubbed in the parent's income. Post clubbing parents can avail exemption of maximum 1500 per child. There is no restriction on children. It means how many member of children also will be, there is no limit. If you have 10 child, you will get per child 1500 rupees exemption. Section 10 subsection 34. Dividend from Indian company. Dividend received from an Indian company is exempt. For this, there is a note. Dividend received from a foreign company is still taxable, and dividend under section 2 subsection 22 clause E is still taxable in the hands of shareholder. This section we have seen in IFOS, that is income from other source. Next, section 10 subsection 35. Dividend from mutual funds. If an assessee receives a dividend from mutual funds such as investment, even such dividend is exempt from tax under section 10 subsection 35. Now, section 10 subsection 37. In a case, if an individual or HUF receives any consideration for compulsory acquisition of urban agricultural land from a central government or RBI announced, then the resultant capital gain is exempt from tax under section 10 subsection 37. Note, the urban agricultural land should be used by the assessee for a minimum period of 2 years immediately preceding from the date of transfer of such agricultural purpose. Next, section 10 subsection 38 and 111A. If any assessee makes a transfer of equity shares that is listed on which STT is paid or levied by the company, if that is long term, exempt under section 10 subsection 38. If it is a short term, that is equity shares is short term, taxable under section 111A at the rate of 15%. Next, section 10 subsection 26 A. In a case of Sikkimese individual, the following two incomes are exempt from tax. That is, 1. Any income earned by a state of Sikkim, and B. Even investment income earned from the rest of the income from securities is also exempt from tax under section 10 subsection 26 A. Next, section 10 subsection 48. A foreign company with the supply of any goods or any services in India, in relation to which there is a agreement with central government. There it means there should be an agreement for the goods or services which are provided by a foreign company in India. So there should be an agreement with the central government. Then for accepting India currency as a consideration, the profit made on such sale of good or services, it is fully exempt from tax under section 10 subsection 48. Next, section 10 subsection 43. Amount received under reverse mortgage. Any amount received by individual under reverse mortgage under a scheme notified by the government. In this case, government means central government. Such amount is exempt from tax. Till now we have seen section 10. Now we are going through section AA. Introduction. SEZ refers to special economic zone. Its area within India notified by government as special economic zone. Now exemption under section 10AA is given for the business set up in SEZ, that is a special economic zone. The business set up in SEZ should have a export capability. Therefore, section 10AA is given a main importance for a export capability. Now, exemption under section 10AA is given only for a period of 15 years, starting from the previous year in which business has been set up. The very purpose of setting up a business in SEZ is to bring a foreign currency into India by exporting. Therefore, one should have a logical that exemption would be given under Income Tax Act only to the proportionate to the export turnover. By seeing this, we can clearly understand that section 10AA is given only for which the foreign currency we are bringing into India. That's why this exemption was given by the Income Tax Department. So this is mainly based on export turnover. Now let us understand exemption. So for first 5 years, exemption per annum is equal to profit of such business into export turnover by total turnover. For first 5 years, you should compute profit exemption under section 10AA by using a formula of profit of such business into export turnover divided by total turnover. After 5 years, from 6th year to 10th year, the same formula which you have seen for first 5 years into 15%, that is profit into export turnover divided by total turnover into 50%. Now for 11th year to 15th year, profit into export turnover divided by total turnover into 50%, or amount deposited in SEZRARA, that is SEZRARA, whichever is low, is given as exemption. So friends, there are some conditions for claiming section 10AA deduction exemption. That is, the assessee, any person should start activity of manufacture or service in SEZ, and the entity should not be started up by splitting up or reconstruction of business with already existence. Therefore, and also 100% plant and machinery should be new. 20% plant and machinery can be still old in that, and separate books of accounts has to be maintained, and audit report has to be obtained from a chartered accountant. The export refers to that amount of foreign currency which is brought to India within end of the financial year. B, within 6 months from the end of the financial year. C, within such period as permitted by RBI. So friends, these are the conditions for claiming section 10AA exemption. Now let us see section 13A. It deals with exemption in the hands of registered political party. If a registered political party have a income such as house property income or capital gains income or IFOS income, it is fully exempt under section 13A. And when we come to the business or profession, a political party is not supposed to indulge in any business or profession as per the registration norms of Election Commission. Let us see once again exemption in the hands of registered political party. If a political party have a income such as a house property income, capital gains income, IFOS income, it is fully exempt. When we come to the business or profession, a political party is not supposed to be indulged in any business or profession as per the registration norms of the Election Commission. Here we have some notes. Let us see. Section 13A exemption is available only in the books. Only the books of accounts are subject to audit. A political party can avail 13A exemption only if a registered political party. It means the political party must be registered. A political party has to maintain a complete name and address of donor making donation of sum that is greater than or equal to 20,000. This is all about section 13A. Now let us see section 13B, last topic in income exempt from tax. Now we are going through last section, that is section 30B in income exempt from tax. That is exemption to a electoral trust. An electoral trust is an initiative of CBDT, that is Central Board of Direct Tax. If the electoral trust has to avail exemption, they have to pass on 95% of opening balance plus donation received during the year to the registered political party. Now let us see the tax treatment of trust. To start trust, the following four are required. That is, 1. Author. He is the settler, that he is the initiative of trust, and there should be a property in trust, and there should be a beneficiary, and there should be a one person to manage the trust. Now let us see two examples to define whether it is a private trust or public trust. Now in first example, father, Mr. X. Mr. X is a father and he has a property, that is building. Now the income which is generated from a property of a trust is benefited to daughter of Mr. X, and that is totally managed by Mr. X friend. Now this is known as private trust because here the beneficiary is settler's daughter. So here it is not benefited to any other person or for any charitable trust, for any charitable purpose. So it is a private trust. Now let us see another example, that here Mr. Y. Suppose you take a Chiranjeevi. Now he has a building and he is providing education to a poor child. Therefore they are the beneficiaries, and it is managed by his friend. Now here the beneficiary is poor child education, that is whole. in India, the beneficiary goes to poor child education. So it is called as a public charitable trust. Now, a trust is not a person. It is like a belief or confidence reposed by one person and accepted by another person. A trust can be private trust or public trust. Only a registered charitable trust can avail exemption under section 11 and 12. If the charitable trust is not registered, the exemption 13B is, that is 11 and 12 under section exemption under section 11 and 12 is not given to such trust. Trust has to be done with Commissioner of Income Tax. The registration would be granted by the commissioner only when he satisfies that the trust is started by a charitable objective. If commissioner rejects to give permission, there is no trust and there is no exemption under section 11 and 12. Charitable trust is treated as individual for tax rate purpose. Now, registration of trust. Registration of trust to avail exemption under section 11 and 12, a trust should be registered under the Commissioner of Income Tax Department. Without registration, though a trust may be doing charity, it cannot avail benefit of section 11 and 12, that is exemption under section 11 and 12. For an application made registration to Commissioner of Income Tax, the application has to be deposited within 6 months from the end of the month in which the application is made. Now let us take example. If the application is made on 19th May 2014, the application has to be deposited on or after before 13th November. Now, a Commissioner of Income Tax also have the power to revoke the registration. That means to cancel the registration of a trust. In a case, if the activities of trust are not carried out as per the objectives of trust, then the Commissioner of Income Tax can revoke the registration. That means while you are making the registration of a trust, you have some objectives. If you don't follow those objectives, the Commissioner of Income Tax officer can revoke your registration. The Commissioner of Income Tax will grant the registration only if he satisfies the object of trust or charitable. Now, understanding the charitable purpose under section 2, subsection 15. Charitable purpose. How you can say there is a charity? Now let us see. If it is relief to poor, or providing medical facility, or providing education, maintenance of historical monuments, wildlife and nature. Here maintenance of historical monuments means, now let us take a Golconda Fort example. There is many people write something on walls. If you are taking care about that, it is also a trust. It is known as maintenance of historical monument. And last, any other object of general public utility. A trust is not said to charitable if it restricts its operation only to a particular religion or caste. However, if the following cases, benefits can be restricted to the following. It means that the benefit should not be given to only particular religion or particular caste. The benefit should be given in the whole. However, the following in the following situation, there is a restriction that the trust can be started for the benefits of SC and ST. The trust can be started only for the benefit of children. A trust can be started only for the female group. So these are the following. They have a restrictions. And a trust can also be a religious trust, but this by itself does not mean that the beneficiary should be a particular religion. So a trust can be a religious trust also, but we should not impose that the benefit should be such a particular religion only. So the beneficiary should be any religion. A trust with an object of general public utility can engage themselves into a trade, that is buying and selling like that. However, it should be ensured that total turnover such trade activity should not exceed 25 lakhs. If the turnover exceeds 25 lakhs, the trust no more treated as a charitable for that year. So friends, here you should be careful. If you have a turnover of 25 lakhs, it means it exceeds 25 lakhs, in that particular only you have a treated as there is no trust. The registration of turnover 25 lakhs is only when the object of general public utility. If the object of the other than GPU, that is general public utility, any size business is allowed. So 25 lakhs amount that is only relates to the general public utility. Now source of income to a trust. Now how the trust gets income to provide a charity. Income from asset held in trust, that is we have taken the property of trustees building, so you can take as a rental income. It is also income to the trust. And another one is donations. In donation there is a two. One is corpus donation or non-corpus donation. One is anonymous donation and non-anonymous donation. Corpus donation not taxable because it is a capital revenue. Non-anonymous donation treated as income and it is taxable. A corpus donation is a capital receipt. It is not treated as income, not taxable in the hands of trust. The donor makes the donation with a specific direction that the amount should be used towards capital. And an anonymous donation is the one where the recipient, that is trust, do not reveal the name and address of the donor. The treatment of anonymous donation is covered by section 115 BBC. Tax treatment of income to a trust. Now how the trust gets income, let us see. Source of income, that is PIT. It is a property of trust and there is a income from that property. And B, non-corpus and or non-anonymous. And C, anonymous donation not taxable at the rate of 30% should include in source of income. And there is a flat exemption of 15%, we should deduct from it. After that, expenditure, that is application of income. A, expenditure on object of trust. Here expenditure may be revenue or capital expenditure, should be deducted from source of income. And next, investment for object of trust, and the trust also includes in the investment for its own objective, so it is also should be deducted from the income. And C, for an amount not realized, claim deduction for it. It is also an we should deduct from income, so it is treated as expenditure. For an amount intimated to the officer for spending next year, it is a expenditure that is incurred for next year, but we have informed presently to the officer, so it is also treated as a current year expenditure. After that, we get what is the net amount. From to that, an anonymous donation taxable at the rate of 30% should add to such income, so we will get total income. Now there is some notes. If a income to a trust is exempt under section 10, still such income should form part of the source of income. Example, if the property in trust is shares of company, the dividend income, though generally exempt, has to be offered as source of income. So friends, if any income that is exempt as per the Income Tax Act should also treat as a income as a source of income to the trust. The portion of anonymous donation which is not taxable at the rate of 30% has to be offered as source of income. Next, tax treatment of anonymous donation. What is the tax treatment of anonymous donation? If it is received by Holy Religious Trust, section 115 BBC will apply. And if Holy Charitable Trust, section 115 BBC will apply. And partly religious and partly charitable. In this, there is two situations. One is if it is received by hospital or education trust, section 115 BBC will apply. Otherwise, then if other than hospital and education, section 115 BBC will not apply. Tax treatment of anonymous donation under section 115 BBC. That is, for example, anonymous donation is 7% on 100 lakhs, that is 7 lakhs, and minus, you should deduct from it amount not taxable at the rate of 30%, that is 5% of total donations or minimum to minimum 1 lakh, whichever is higher. That is, in our example it is 5 lakhs, therefore the remaining balance is 2 lakhs. And there is a note: the amount of anonymous donation which is not taxable at the rate of 30% should form part of source of income. That is, we have saw an example in that we have included, that is amount which is not taxable at the rate of 30% as an anonymous donation. Who is the benefits to a specified persons? Now, benefits to a specified person: a trust availing exemption under section 11 and 12 should not provide any benefit to a specified persons. That is, a settler, a trustee, that is manager or the controller, the relative of settler or manager, any entity in which A or B or C holds substantial interest, and a person being substantial donor makes a donation greater than or equal to 50,000. A education trust or medical trust can provide benefit to a specified person. However, the expenditure incurred to provide such benefit cannot be taken as an application of income. Now, last topic of income exempt from tax, that is note on the registration of trust. Here, note on registration of trust. Here there is a previous year, that is 14-15. Here there is a previous year, that is 2014 and 15. In that, star 1 indicates trust started, and the star 2 indicates an application to registration for a trust. That is, and trust made an application for the income tax department for its registration, and in the next year, that is 15-16, the Commissioner of Income Tax approved and registration were granted. Now, in this case, if the application is approved by the Commissioner, it is deemed that the approval is granted on first day of previous year. It is, in our example, that is in 14-15, first star, it has been dated 1/4/2014, that is 1st April of 2014, in which previous year application was made. It means the trust came into the picture from the date of 1st April 2014. This is all about income exempt from tax. So friends, we have successfully completed one of the topic of direct tax, that is income exempt from tax.